Brian Stevens here with Barry Habib. Listen, the last couple of days have been as crazy as I've ever seen in my 25 years of doing loans. And I'm looking at some of the things that have taken place. And I got to admit, I find some of it confusing, but I know it's important. That's the only thing I know that it's important. So here's the first one I want to jump into because we know Barry's got the answer to it. Everybody's looking at this yield curve inversion with the 2 and the 10 and the 10 and the 2. And Barry, I was looking at one of these St. Louis Fed Reserve graphs, one of the Fed graphs, and it showed whenever we saw this inversion, literally before every recession that we've had this inversion. And that was the only time we've seen this inversion going back at least the last 40 years. So is this the best indicator that we're going to have a recession? Is a recession inevitable, or is this just, handy penny, the sky's falling?
So there's a lot of ways to answer that. So the first thing is, yes, a recession's inevitable. That's because it's a cyclical economy. So you're going to have a recession. The question is when. That's what you'd like to know. So a precursor to recessions, you do get a few things. So the inversion of the yield curve is a very reliable one. And the inversion of the yield curve happens when things become unnatural. So you have a shorter term maturity. Look, imagine you go to the bank and you go to look at your CD options, right? And you're going to put your money away. You say, well, I'm looking at this 3-month CD and it's this rate. And then if I make a 1-year commitment and tie up my money for a year, I expect to get a little more compensation. And certainly if I put my money away for 5 years or 10 years, I expect even more compensation, right? So because of this, it's a natural curve for yields. The longer out you go, the higher the rate of return that you get. Except that right now, we're seeing inverted yields. And it's been happening for a long time. The 3-month has been higher than the 1-year, which was higher than the 2-year, which was higher than the 5-year. And now that 2-year is even higher than the 10-year. And that oftentimes is a piece of the puzzle that people look like as a concrete indicator. You'll probably see a recession about a year down the road. And look, for a long time, what was my call? 2020. I mean, I've been on with you. I've been on with Frank so many times saying 2020 looks like a recession year for us. And it probably will be, but it's not so important that you actually get deemed a recession as it is in calling what the factors are and what's happening. So the biggest one that I called was when the 10-year was at 240, saying we're going to go to the lowest rates we've ever seen, below the 137 and 132 intraday, maybe 110, 120, maybe even 1 on the 10-year treasury. Why does that happen? So here's what happens, and here's why the yield curve gets inverted. So longer term maturities. Imagine this. You're lending out your own money to do a mortgage, and I'm paying you that mortgage payment. So I'm paying you every month. Say it's $1,000 a month. So you take that $1,000 a month and you buy stuff every single month with it. But because of inflation, the buying power of it kind of erodes over time. So if inflation were to go up, the only way you could protect yourself is to have a higher perch, a higher payment, a higher rate to get there. So inflation goes up, rates go up. If there's no inflation, you could afford to have rates come down. So that's a very big driver of interest rates. So when the longer end of the curve that's worried about inflation is saying there's no inflation out there, rates are very low, that tends to show weakness in the economy. Think Apple Store. And before Apple releases a big new thing, people are sleeping out there. Certainly Apple's not going to put it on sale because people are flocking there to buy it. They've got pricing power. Well, when you have no inflation, it's because you have no pricing power, because there's not a big demand, which means the economy is kind of weak. So the longer end of the curve is saying, things are kind of weak. And because the globe is so interconnected, maybe not just here, but there's 16 trillion with a T dollars of negative interest rates throughout the world. It's insane. Yeah. And because of this, what happens, Brett, is that we get ourselves in a position here in the US that our rates look exceedingly high and they're being dragged down. What also drags down interest rates here is debt. Think about a family that has so much outstanding debt that their discretionary income is like this. So they can't buy stuff, so they have no pricing power, keeps inflation low. Well, governments everywhere, US, China, Japan, Eurozone, everywhere. When debt levels get so high, your discretionary spending for programs is shrinking, and therefore it has a very, very gravitational pull down on inflation. It compresses and pushes inflation down. It's a fact everywhere in the world. We've got the charts. We show it in MBS Highway. Every single place in the world, as debt goes up, interest rates go down. Why? Because inflation goes down, so rates come down. And we know debt is not going to be reduced here in the US. Debt's going to keep going up, which really kind of keeps a lid on interest rates and compresses them lower. Now, the shorter end of the curve, the 3-month, the 1 year, and the 2 year that you mentioned, they care a lot more about shorter term rates for competitiveness. Why? Because inflation's not a big deal. If I have a 3-month instrument, who gives a damn about inflation, right? I mean, inflation is something that it's not going to make a big difference in 3 months. 10 years out, yeah, it will. But 3 months, who cares? 1 year, who cares? Even 2 years, it's not going to have that big of a bearing on me. If inflation goes from 2% to 2.5% in a 2-year period, I'm not feeling the pinch enough. So those yields care more about competitive forces, and the biggest competitor is the Fed. So they care about the Fed funds rate. So that Fed funds rate is pushing those shorter term yields up, and the longer term's coming down because of inflation, hence inverting the yield curve.
Can I ask you a question on that? Because
let me just finish the thought.
Oh, please.
So it's telling you the economy isn't strong and the Fed isn't responsive. The Fed is too high when we need the Fed to be lower. Because of that, you're seeing an inversion in the yield curve, and the inversion is the symptom. The result is you get a recession because the economy's sick and the Fed's too high.
So speaking of the Fed and speaking of negative yields, I thought this was really interesting because I didn't know this. But right now you've got Japan, Switzerland, France, Sweden, Germany, Austria, Spain, Italy, the Netherlands, Belgium, and more.
Switzerland is the biggest one.
In Switzerland, and it's saying here 42% of negative yield debt in the world is with the Japanese. And Alan Greenspan came out and said that Treasury yields falling below zero is not a problem for the United States. Is it that so much of Europe and Asia right now already has negative yield debt that we're just joining the game? And does that all but guarantee that we're going to go into is that another indicator that a recession is on the horizons because we're seeing this in other markets?
So again, a lot of good points you bring up. Let's just try and unpack them. So is it an indicator that we probably get dragged into recession? Yes. Is it, as Alan Greenspan said, not a problem? Absolutely not. It is a problem, because if you're in the banking sector, you cannot make money with negative yields. You can only make money in a positive yield spread, okay? You can't make money by pushing out negative rates, okay? Now, as investors, we can make money in this situation. I'll tell you how. But what happens here is that you need positive rates so that you can make margin. There are mortgages right now in the Netherlands which are yielding a negative rate. So this doesn't mean you take out a mortgage and you have no payments. Here's what it means. If you had a reasonable interest rate, let's just say your payment would be $1,100 a month, $1,100 a month. Instead of that, if it was zero interest, maybe your payment might be $1,000 or $900 a month. Because of negative rates, you're getting $50 off of that or something like that. So yeah, you're saving a lot of money because of negative rates, but you're still making payments. People get confused. Oh, wait a minute, you mean to make a payment? You're making a payment. You're paying principal, but you're getting an interest credit towards principal. It's pretty unbelievable what's out there today. I don't think we get there here because our banking system would collapse.
I mean, that's pulling money off the streets, right? Isn't that essentially what it's doing?
Well, what it really does is it makes banks be in a position where lending is unprofitable. And as lending becomes unprofitable, that's the lifeblood. Why would I lend money if I'm guaranteed to lose money on it? So therefore, I'm not willing to lend money. And that lending money is the oil that supports the economy. So that's where you get economic slowdown.
So a 2020 recession, it appears from a lot of indicators that it's inevitable, something you've been calling for quite some time right now. Does that then mean we're going to be in a low rate environment, somewhere in the, maybe low 4s, mid 3s for the next 2 or 3 years?
It's always hard to say exactly how much time, but the call that I made was we're going to see the lowest rates we've ever been to, and everybody thought I was nuts. And all of a sudden now we're 13 basis points away from the lowest rate ever on the 10-year right now. So we're definitely going to get there. So we'll have that, but how low will they go and for how long will they stay there is what I think you're asking. And the answers that I can best come up with is I see the 10-year Treasury, if you want to use that as a barometer,
sure,
probably somewhere between 1 and 120. And I think it faces a lot of resistance at that level. So I think that's probably an area, and it's no man's land. So it's going to be a bit volatile. We will get down, but we won't be in a straight line. I always say this, won't be in a straight line, but the direction is lower for yields. How long do we stay there? I think that you'll never again see a 7% mortgage for sure. You may be hard pressed to see a 6% mortgage, but I think it is definitely as you say, we're going to be in a low interest rate environment for a very long time. Now, low interest rate is relative, right? I mean, we talk to customers and you quote them a rate today and you say, 4.5%. Like, "Ugh, that's high." Well, high relative to what,
Right.
To the last 200 years, not, it's pretty darn good, but relative to, maybe 4%, it appears high. So we could be looking at people talking about rates at 3.5%, talking about that being high. I mean, I think you will see the lowest mortgage rates you've ever seen. And that means maybe even scaring a 2 handle on a mortgage, which means, 2 7/8 or something like that. But I think we're certainly going to be in the 3s for quite some time.
So here's where the rubber meets the road. And I love what you said about relative. A 5% interest rate is super low relative to 7.5. And if we're in a low rate environment right now, and we're going to be there for quite some time, I'm looking at an MBA, a Mortgage Bankers Association refinance application index that goes back to 1990. And so we're in a high refi market right now, but this is what really struck me. 1998, 1999, 2001, 2003, 2008, 2009, 2011, 2013, 2014, and even a point in 2017, we saw the MBA refinance application index significantly higher than what we're seeing right now. So this seems like a hot refinance market, but it's not nearly as hot as the markets that I just said over the past 15 years or so. And I think that's because
we haven't gone through the cycle yet. We all know this, right? We all know that when do customers get off their rear end? When rates start going up, not while they're going down, okay? Everybody's hearing now, and this is why we got to be careful. Everybody's hearing, the Fed's going to cut, the Fed's going to cut. So people equate a Fed cut with lower mortgage rates, and sometimes that's true, but sometimes it isn't. And the smart people out there are doing the advice that I know you've been talking about as well, hey, listen, refinance today, okay? And you do it smart. And you've heard me say this many times. I've done this with Frank so many times, saying, don't pay points, don't pay upfront MI. Try and include as many closing costs as you can. Take a higher rate, not a lower rate, but keep your costs low, because your probability of refinancing this 6 months or a year or whatever down the road is really high. But in case we're wrong, nobody's perfect. What if we're wrong? And what if some event that we don't see on the radar comes up that pushes interest rates a bit higher, and it doesn't make it wise for you to refinance? You miss this opportunity. Here's the other factor that no one considers is, let's say if it takes 6 months to get to a rate that's like at the bottom, or a year. What about the savings you could have had in 6 months or a year? That you could have saved and banked. It would take a long time for the incremental benefit that you're receiving a year down the road to catch up to that. It might take 2, 3, or 4 more years. So you'd be waiting 5 years to take advantage of what you could take advantage today. And if rates do go down and you do it smart today, you do it again in 6 months or a year, and again, keep your costs low.
Okay, so that's my point. And what I was talking about yesterday, it's the relative to rate that you're refinancing out of, the relative to, and I think, going from the 7s to the 5.5s, we've seen those in years past. My question is, if we're refinancing people at 3.5, 4% today, are lenders then painting themselves in the corner from future refinance markets? But what I think I hear you saying is, refinance them today, take the higher rate, it's going to be better for you. And if we do get down in the 2s, you're going to have an opportunity to refinance again, maybe a year or 2 down the road. And that's a better bet.
Or 6 months down the road, and it doesn't have to get into the 2s. I mean, let's face it, if you did somebody's loan today, 4%, little to no closing costs, you may be in an opportunity 6 or 8 months from now to be at, or who knows, sooner perhaps, to be at 3.5% with 0 to no closing costs. And do that refinance again. And this way you have the benefit, but you've also locked in assurance that if you're sitting with 4 7/8 today, you went down to 4 and saved a boatload of money and didn't pay for that. It's just money in your mailbox is what I call it. So if somebody says, here's some free money in your mailbox, there's no risk, there's no investment. This is something that there's few things in life that are truly what you call a no-brainer. We all say no-brainer, but it is a no-brainer to not pay anything and receive a lower payment. And by the way, for all those people who say, well, I'm two years into my mortgage, now I'm starting off from 30 years old. Here's your answer. I can do a 28-year mortgage, or this is even better. If you had a $400,000 mortgage and 2 years later you owe $385, instead of doing the balance at $385, do it at $400, take the $15,000, pay it down to $385, and you'll be at the exact same place in the amortization schedule you are. You are taking those 2 years, but you're saving it because you're making the payments based on $15,000 less than the original loan. People don't think about these things, and they're very important to explain to customers.
Here's my takeaway is my concern was that the relative to possibility here is going to, paint lenders in the corner to where there's no refinance markets in the next 4 or 5 years, something we really don't often see. What we're hearing from Barry Habib today is take the higher rate. It's going to be better for your consumers. And I agree with that.
With low cost. But the other thing too is that there'll always be refinances because you always need a reason to refinance. And the big one that nobody is talking about, and it is so huge, and that is you've been given this amazing gift, and that is equity buildup over the past 7 years. Real estate values have done so well. And now you've got all of this equity. At the same time, most of your clients have a boatload of debt. Be their debt manager. Change their life for the better. Take some of that equity at these low rates. Pay off the debt that they have, change their payment structure, take the savings in payments, put it back in the mortgage, and now bring their payment term down dramatically. You will be able to build up so much equity. It is like a miracle of what you can do for your customers. So those opportunities will exist. And the examples that we use, we have a great tool for this, but the examples that we use is we say, hey, look, imagine somebody sitting with 3.5 and you take them to 5%. Well, guess what? You can save them 12 years on their mortgage and give them an extra $300,000 to put their kid through college. These are the types of things that exist even with that disparity. Imagine if you're taking them to, that's saying somebody who's got 3.5%, putting them in a 5% mortgage, you could change their life for the better by paying off debts. The key is being a debt advisor and looking at the big picture. Don't be so focused on the little things because you are someone that is such a great champion, and both of you guys, Frank and yourself, talking about fintech companies, how that's the real enemy out there. I mean, you guys identified that before anybody, and you guys talk about that all the time. The best way to protect yourself and be that person that people want to go to is to truly be an advisor. Now,
I agree.
The thing of it is you can't put a sticker on and say, oh, suddenly I'm an advisor. You have to do the work. You have to have the tools. You have to be that person that can give advice. And one thing that drives me freaking nuts, by the way, is I see it come out of the woodwork. I just got to tell you, it's a pet peeve. I see it drives me crazy. You might get, and rates don't go down in a straight line. They almost have, but for the last 9 or 10 months. But rates will go up like 2 days. And everybody says, oh, that's why I always lock. That's why I lock everybody. That's why. I mean, are you freaking nuts? What is wrong with you? I mean, really, what is wrong with you? I mean, first of all, the definition of being an advisor is giving advice. So if you're a robot that says, I'm going to lock everybody under the sun as soon as they come in, how's that worked out for the past 10 months? How many upset clients do you have? How pissed is your company with all your pricing exception requirements? You are not an advisor. You're a robot, and you're just doing that because you don't want to put the work in. I mean, we're not saying that everybody knows what the market's doing, but certainly if you're watching the markets, you're not going to have somebody go from 4% to 9%, rates going to go up. I mean, so if rates go from 4 to 4 1/8 because rates went up on you and you're not watching the market, you took your eye off the ball, okay, that's not great, but there's so much of an important opportunity because as rates have gone from 5 1/4 to 3 3/4 now, how happy are your clients that you locked at 5 1/4? I mean, really, just think about that. You have to force yourself to be educated. It is no longer acceptable with fintech companies, no longer acceptable to be robotic and to say, I know how to qualify somebody, so therefore no, you're out of business because of fintech in the future because of that. You really have to be an advisor. I mean, you've got to wake up and smell the coffee and don't fall asleep because your belly's full now with all these refinances that you've been given as a gift. Because when it does dry up, and it will dry up, it's cyclical. One day when it dries up, fintech is waiting to take your business from you. That's what they want to do. And the only way to protect yourself is to be smarter than they are. And the only advantage you have, because they got more money than you do, more resources than you do, but you have more intelligence. And you're a better quality originator because you're debt.
Yeah, Barry, I couldn't agree with you more on this. And the reason why these companies these fintech companies are doing so well is that we have, as an industry, gave them enough oxygen to exist. The best asset that a loan officer has is that you are local and you have the ability to be a true professional, not a collegiate, not a college player, but a true pro. Kean Ramsey is in my office. He said the difference between a pro basketball player and a college basketball player is a pro basketball player can hit a layup with their left hand too. And that's what we really have to do in the mortgage industry is we have to get small, get local, and be a true professional, exactly like Barry's talking about. I couldn't agree more with you on that whole point. Be a pro. I want just one last question. I know we're going long. This is why Frank does the interviews with Barry, because I just want to sit here and ask questions all day. So I've been looking at this whole thing saying, well, if we do have a recession, a national or global recession, I think for us, it's not going to be that big. Frankly, in the housing industry, I think we should just call it a correction. Even if everyone calls it a recession, and for every facet of industry, for the housing industry, it seems more of a correction to me. Do you think if we have a recession, do you think that we'll actually see prices go down or just continue to go up at a smaller clip? Because I've been looking at new permits for the New Home Builders Association. They're down lower than they've been in years. It's like we don't have any relief with additional inventory in sight. So I can't see, even if we have a recession, that property values are going to actually start to tick down. Do you think that is a possibility?
So there's so much good stuff in what you said there once again. So first of all, let's understand the housing market is very diverse. So first of all, it's diverse by location, okay? So there are some markets that are going to do better than others, but also it's by price point. So think about in your marketplace, what constitutes the limit of an entry-level home. In some markets, it's $250,000. Some markets, it's $500,000. Some markets, it's greater than that. That market, it's on fire, okay? That'll be on fire. That's on fire. There's simply not enough homes. Builders are building 25% less homes than people are requiring, okay? So that's too tight. It's too hot. Rates are too good. That's going to be great. Then there's the next move up level. That's okay. And if you price your home well, you'll do well. And then there's the upper echelon, and that's soft, okay? But because those numbers are bigger, they tend to bring down some of the averages that you see, and then the media loves to report anything negative. But every market right now for entry level is doing pretty darn good. That next level is okay, but it's the upper echelon that's struggling. So we have to understand it's diverse by location, but also there's truly 3 markets out there. In every real estate market, there's 3 markets within a real estate market. So it's something we have to consider. Now, how about a recession? So here's the deal with a recession. Housing historically does well during recessions. Not the last one, but it was a housing-led recession.
Right.
The housing bubble put us in the recession. Why was there a housing bubble? Because I did this. I went, okay, you got a mortgage. You're qualified, right? 100 LTV, no income, 580 FICO score, no job, non-owner occupied. Really smart, right? So yeah, we wonder why those things collapsed. Of course. So you don't have that right now. Loans are performing incredibly well. Think about looking at 400 homes in the distance. Only one of them is in foreclosure. 400, it's one too many, but homes are in good shape. Positive equity, 40% of people own their home free and clear. Yeah. We're in probably the strongest housing market in the history of our nation. So I think we're going to be okay if there's a recession. So what happens during a recession? The unemployment rate ticks up. By the way, this is the number one indicator. That inverted yield curve is important, but the number one indicator, watch the unemployment rate. If the unemployment rate goes up about 4.1%, I'd be very careful. Stock prices get hit. And there's places you can make money, like right now. Like I've talked about this. I think long-term treasuries are great. I think gold's a no-brainer. How's gold not continue to go up? The Fed's going to cut 3 more times, So these are places that you can make money. But the equity markets at this point in time can be shaky during recession. So you got to be careful. They drop between 36 and 50% usually during recessions. So just please be careful. But here's the key. The key is when you look at that unemployment rate starting to go up as it affects the housing market, it will go up quickly. So let's just call it a round number. It's 3.7% right now. Let's call it 4. So it goes from 4%, shoots way up to 8%. Uh-oh, there's 160 million people in the labor force. That means that we're going to see 6 million people unfortunately lose their jobs, which means let's call it 3 million households. Now, the last thing in the world they're going to think about doing is buying a home. So 3 million of them, that's bad. But rates, if they go down another 0.5%, you'll have 6 million households now qualify for a mortgage that they couldn't qualify before. So yeah, the negative, you lose 3 million households because they lost their job, but you gain 3 million households, 6 million households because they can now qualify. So you have much more demand to buy homes. That's why real estate does well. And then when you look at it juxtaposed to renting, oh my gosh, what a no-brainer. Buying a home is so much cheaper. In many markets today, buying is a cheaper payment with 10% down, certainly with 20% down than renting. Even with 5% down, it's oftentimes cheaper to buy than rent. Not everywhere, but it will become even more of a benefit to buy as rates continue to drop another 0.5%, which they will.
Wow. Well, there you heard it, guys. This is great stuff. Like I said, and maybe it's just because I'm looking at this stuff more than I have in years past, but in my 25 years of writing loans, this is as close to the craziness as 2008 I've ever seen. And I think that we need to really understand the waters that we're navigating. I think that we as loan officers, being the professional that Barry's talking about, I think we need to really be able to read the tea leaves of our market so we can make decisions accordingly. You can't do that without this type of information that you're getting. So this is hugely important. And by the way, as a loan officer, when you share this information with your real estate agent partners, with your past, existing, and future clients, what it does is put more texture on the canvas of your business. It gives you more credibility. I can't stress it enough about being a professional. I mean, listen to Barry on this stuff because this is great. So Barry, thank you so much. I know we went long, but I think this is great information.
No, and by the way, thank you for everything you do. And I think everybody watching you guys should do everything they can to support you, because what a champion you guys have been for loan officers and for realtors. I mean, you guys, you guys do so much to look out for them. I mean, I watch the show religiously every day, and I can't believe the content you come up with, because you guys really look out for realtors and mortgage professionals, and you're out there for that person who's working hard and trying to help protect them from some of these large entities that don't always act fairly, as you guys have pointed out so many times, and you point out where those levels of unfairness are and how to combat them. So it's been really great watching you.
Barry, thank you so much. I appreciate the kind words.